Good afternoon, everybody. Welcome back to the Market Mentor Ventures channel. My name is Dahuda Hunter. I am the Market Mentor, and today I'll be going over my June monthly market breakdown. Within this presentation I've put together, I'm going to be utilizing the Stock Traders Almanac of 2025 just to help us get a basis of what history tells us about the month of June and what the summer looks like, and then compare it with what happened last year and what our current events looks like for the rest of the month. And then I'll also share what I myself am looking into for this month going forward. I know in the last video that we had shared, we discussed the importance of buying when there is fear in the market, and there was extreme fear compared to how it was with COVID, and I shared that example as well. Likewise, what happened last year in August as well. And here we are by the end of May, we're back at greed. Like it's crazy that it felt like in the midst of that extreme fear, it felt longer than it actually was. It only took a month to get back to greed, which is crazy. So I'm just going to take myself off the screen for a bit and we'll jump right into the presentation. All right, so full disclaimer, this content is presented to be used and must be used for informational purposes only. It's important to do your own research before making any investment decision based on your own personal circumstances. You should take independent financial advice from a professional or independently research and verify what you hear on this channel. So let's get into it. What does history say about June? So there are a few points that I pulled from the almanac, and those were that there's a sudden drop in volume, specifically after Memorial Day weekend that marks the unofficial start of summer. There's a significant drop in volume slash uninspired trading on Wall Street. Since 1964, the summer has produced the weakest rally of all seasons in the Dow Jones. The NASDAQ is known for having their best eight months from November, and it ends with June. From what I was reading through with it, in my opinion, it comes off as if it gave more of like a bearish to mixed outlook when it's discussing the summer. But in actuality, it's not 100% the case, because over the past 61 years, on average, say the winter averaged a 13% gain, starting from a low in November or December to the Q1 closing high. The spring had 11.7% increase, fall 11.2% rally, and then the summer had a 9.4% rally. So it's not necessarily bearish, it just happens to be the least profitable rally out of all the seasons. But history is supposed to just provide a baseline or a context. It doesn't have to have set rules, nor does it guarantee the same results in the future. It's used as context, and that's how we should use it. Moving on with market leadership possibly shifting again. So what happened last summer? So last summer, it was surprising to a lot of people because AI was hot. It literally carried half of the year. But when July hit, those gains came from small caps, real estate, and regional banks. And the Magnificent Seven had actually dropped 2.7% during that same time frame, which is kind of wild. Majority of the market relies on that Magnificent Seven. But here we are today. AI is still very much so prevalent, right? But it's starting to hit some friction. You know, Nvidia took that 5.5 billion hit related to those export bans to China. And that caused them to lose 8 billion in potential revenue. So with that being said, tech was down this year. Everything was down this year. But like I said, just by the end of May, everything seemed to like break even and come back into the positive territory. So we're not seeing the same rotation as of yet, but it's important to be more selective and intentional about where strength may be, right? Next thing was, it wasn't the cuts, it was the hope of cuts. So that's what happened last year. So rates weren't actually cut in the summer. It happened in September. But when the July inflation results had finally dropped under 3%, the expectations of the cuts and that hope was what ripped the market. That was then led by real estate, regional banks, home builders. Both real estate and the regional banks had gone up about 18.5%, and home builder companies had gone up about 17.6% on average. Whoops. As of today, though, Fed cut 100 basis points in total last year, but since the beginning of this year, we've just been sitting tight, and we may not see another cut until July. It was initially projected that we would have four total rate cuts throughout the year, and that got cut in half to just only having two. Much of that being related to inflation, uncertainty with all these tariffs that suddenly came about, right? So instead of trading off of anticipation, it's more so about caution and looking for certainty at this moment, which fortunately it feels like we can't get a hold of. It feels like 1 week there's a decision made and there's certainty for like a couple of days, maybe a week, and next thing you know, something changes, and now we're back to that same uncertain feeling. But at this moment, the Fed's is holding rates at 4.25% to 4.5%. Like we just said, only projecting two cuts possibly for the rest of this year. So that's what we have to look for going forward in these next Fed meetings. As we were talking about that, trade tensions. We didn't have any trade issues in the summer of 2024, so that helped the market, and global supply chains were smoother. That also helped support the market. Look forward to now, as we just mentioned, there's tariffs everywhere. You got the steel tariffs that doubled to 50%, aluminum tariffs jumped to 25%. And then in more recent days, like last week, we had that plot twist with US and China agreeing to pause tariffs for 90 days, and they dropped the rates down to 30% and 10%. And literally, I think it was the day after that, US courts ruled that the tariffs were illegal. All the tariffs that Trump has been placing are illegal. But there's a stay in place at the moment, so we're waiting for a final decision. The day to look out for that is June 9th. That's when the next big legal deadline on that situation should be happening. With all that back and forth, it just creates uncertainty. And uncertainty, as we know, slows the market. Economists are saying this could knock almost about 1% of GDP, knock off about 1% of GDP from this, as well as costing families about 1,200 a year. That's no small dent. Like, I'm sure we can figure out what more we can do with 1,200 a year, right? So all these reciprocal tariffs and new duties is causing a global tension, and that leads to uncertainty, which leads to investors being a lot more cautious. Moving on to the mindset has also shifted as well amongst consumers. Last summer, consumers kept the market alive. Even though there were high prices, high rates, the retail sales stayed pretty strong and companies were delivering solid earnings. Confidence was fine. But this year is a completely different story. Confidence is at one of its lowest points we've seen since 2022. People are deciding to save a lot more rather than save a lot more and are dipping into savings. And almost half are delaying purchases because of the tariffs. Like, this is affecting every industry you can think of, whether it is buying a car, whether it's the wedding industry, whether it's housing, you name it. It's affecting everything across the board. And that tells you why retail earnings are shaky and the sentiment is low. Retail sales growth slowed big time from 1.7% to 0.1% monthly. That is a crazy drop. So definitely a lot of young people are just definitely pulling back faster. And then also to add on to it, we have the whole job market. That doesn't make anything easier for the consumers as well. I mean, if we have tons of job cuts, how are they paying for the things that they need? So that is also something to think about as well. These are the kind of shifts that we got to pay attention to. So when the noise is loud like this, clarity is power. Clarity is power, right? Back to just jumping back to the consumer confidence aspect of things. Per McKinsey and University of Michigan, consumer confidence is down 26.5% year over year. That's crazy. That's crazy. So if you guys like this breakdown, make sure you guys hit that like button and follow. I will be having more updates coming each month. So make sure you stay tuned in and tapped in. Right. So next, we're going to tap into ETFs and the sector watch list for June that I currently have for myself. I've currently been looking at XLV, XLP, and of course the semiconductor space. Understanding that XLV is and XLP is more so defensive sectors. They say defense wins championships, right? So in times of uncertainty, those defensive sectors tend to do a lot better than the rest of the broader market. XLV, we have here, they have their top holdings, Eli Lilly, which makes up just about 14% of their holdings. You have United Healthcare, which, as if we've been paying attention, took that crazy hit. I think they are just about 50% off its all-time highs right now, or a little bit over. Johnson and Johnson at 7.36%. You also have your consumer staples. These are items that, whether there's a recession or not, we're going to need them regardless. We have to go and get food. We need clothes. So top three holdings, Costco makes up about 10% of it, Walmart 9.73%, and Procter & Gamble is 8.79%. I kept SMH in here. I know it's not really a defensive sector by no means. It's actually one of the more volatile sectors in the market, but also just understanding that AI is what is pushing the envelope for essentially everything. AI is in healthcare. AI is moving into fintech. It's everywhere at this point. So it's not like this is just a come and go situation. People are going to be utilizing semiconductors for here on out. I mean, we've always been using it. It's just that advancement in the technology has been so quick. It's only going to progress. So this is more so of like a long-term outlook that I have, at least for the semi space. And with that said, I'm going to share some of the charts that I got. Let's pull that up real quick. Alrighty, so we have XLV here that I'm looking at. It's your first time here on my channel. I typically use the color orange when I'm dealing with the 2 month time frame when I'm looking at my charts. I work with yellow when I'm dealing with my monthlies. When I go down to my weeklies, I use blue, but I like to use this rectangle here to kind of give a gauge of, it helps me give a gauge of the range a company or an ETF has been trading in. And I see here from 2021, it's been kind of settling around within that range. So I use the 2 month candle just to get that bigger snapshot, and then I break it down and I go into smaller time frames here. So just to show you what I've been looking at on a monthly basis since 2021, the healthcare sector has literally been respecting this trend line the entire time. It's one, a wick down, 2, 3, 4, 5, and came well above it. And then last month literally closed essentially either right on the line, right below. It's right there though, right? And in my head, you have to think about risk to reward ratios. I'm not going to look at the company when they're at the top of a range and I'm looking to go into a call option or even just purchase shares for all that. You know, the rule of thumb is never buy at a high. But if I can find somewhere that I'm finding support or resistance, support, sorry. If I'm finding somewhere that I see support, my chances of getting a good gain on it is a lot more higher than entering it when it's near a resistance level. That being said, this is why I was interested in XLV, because if I even come down to the weekly, I saw that it's near this range. It's at the 200 EMA, which is a key EMA level, because we see here it got down to almost got down to it and it bounced above it. Let's see, does it go down here? Right here, even in this month alone, that was COVID, March 2020, it did go below it and popped above it still. And it only 2 months underneath that 200 EMA and it popped above. So it's interesting to see that. But more than anything else, I also understand that relative strength index, the RSI, it's on the lower end of things as well as the money flow. So that's what I'm looking at as well, because when you're looking at finding entries, you want to make sure that you're not getting in at like an over you want to make sure that you're getting in at an oversold level, and it's much closer to oversold than it is overbought. And then here I was able to pick out some bullish divergence, because I marked this is the RSI here that I'm looking at, and I marked, actually I could do it right now, from this level on the RSI here. Let me just change that color to white for the daily, and this is a daily time frame I'm looking at. It has been on a downtrend here, but the RSI is doing the opposite, and that's bullish divergence. So we see here the RSI is all the way down here. The price level is about the same or less, but the RSI is higher here. If the price is lower, RSI should be lower as well. So a few different confluences that I'm looking at is seeing that, is realizing that it's at an area of support that it has tested in the past and bounced off of. We see some bullish divergence here appearing on the daily. Let me double check the weekly. We see the weekly it's been hovering around this 200 EMA, which is a key level to pay attention to. And let me also take a look at MACD on the weekly. These past 2 weeks this week hasn't closed yet, but we do see that sellers are lightening up here based off of that MACD. On the daily, we do see that we have crossed and turned bullish. And what does it show on the monthly? Monthly, we're still bearish, understandably so. It's a bigger time frame, but on the shorter time frames, it's showing signs of a reversal, turning green on daily. What's the 4-hour? 4-hour has been green. So those are some things that I try to pay attention to when I'm trying to make a sound decision on getting into a company, doing options, whatever the case may be. And again, this is not financial advice. This is strictly used for informational purposes only. Another thing that I shared with my Earn Your Leisure family, if you guys aren't a part of that community, I think you guys are doing yourself a disservice, because there's a lot of gems that is often being shared in that community, whether it's real estate, our investments group, mental health and wellness. We have a group for mature earners 50 and over. So if you guys have not heard of it, I'm glad you're here, so I can tell you to take a look at that community, because that community is amazing and I'm grateful to be a part of it. So that's what I wanted to share. XLV, also understanding that, it's important to take a look and research what the average drawdowns on certain companies are, companies or ETFs, or sectors, whatever it may be, because that can also give you a gauge as to if it's a proper time to be buying shares, or if you should hold off and let it come down to a certain level. That's a key role in being able to manage your risk to reward. I know we go into a lot of detail with the family. I don't want to spoil it for them, so I'll leave that up for homework for you guys to do. And then we also talked about the consumer staples. That's XLP here that I'm looking at. And let's see, we'll go to the 2-month. As we see here off the bat, like, they're at all-time highs. So it's kind of tricky. I wouldn't say tricky. It's just, in my opinion, it doesn't make sense to enter anything, whether it's buying shares or buying call options, because we're at resistance. I know this orange line, again, it refers to my 2-month time frame. We see we're hitting resistance levels here, and it looks like that has turned into support. with this impulsive candle right here. We've seen over the past 2, 4, 6, 8, 10. This candle is not closed yet, so I'm going to stick with 10. But over the past 10 months, it has always closed above this 78 level. So it's interesting to see what will happen by the end of this month. You can go down into shorter time frames on the monthly, see if I find any more details per se. It's a crazy morning star pattern right here, and we still managed to dip down and come back up. Let's see what we find on the weekly. On the weekly, again, my blue lines are for my weekly time frame, and I do see, again, as I mentioned, we're at an area that has been consistently resistance, going back to September of last year. We hit it 1, 2, 3 months here. We came close to it here. May, we got up there and came back. That's the middle of May right there on the weekly time frame. So we're back at resistance again. So you never want to buy into resistance. Yes, there you can also make money on price action coming down. Those are called puts. But I very rarely actually play puts. I don't know why. I don't know. It could be a psychological thing. Who knows? I'd rather not bet against the price going down. But on the other end of things, we do also see a support trend line on the weekly time frame, at least. Yes, it did break through here, but it still managed to close well above that trend line that's drawn here. So it's interesting. It's going to be interesting to see what happens in the next 4 months. Typically, when this happens and all this consolidation occurs, another impulse move is coming, whether it's coming down or it's going up. So that's what I'll be looking at for XLP. Let me see on this one, the money flow. RSI is 58 at the moment. The money flow index is closer to the overbought side of things. That's the 4 hour. Sorry, let me pull back. 2 months. The 2 month we see is definitely closer to the overbought side, as well as the money flow index. Monthly, we're at 59. Money flow is 58. As for our weekly, we're at 57 and 40 and 57 and 53 for the daily. So yeah, it's quite interesting to see what's about to happen with the XLP. Me personally, I'm just observing at this moment because I know that it is at an all-time high. I'm not really pressed to do anything, and that's one thing about trading. I mean, sometimes it's better to just sit and watch. If it doesn't look right, it's not a part of your setup, then just be patient. There's no real need to rush into a trade if it's not your setup. And then last but not least, we'll definitely touch on SMH, of course. And again, like I said, I like to start with the 2 month time frame using that orange just to see if I can find a range that it's been trading within. And since March of last year, it's been consolidating within this range here. Again, this is the current candle we're in, but keep in mind it's a 2 month candle, so this candle will close in June. So this is still an active candle. We can go to the monthly. We do see that there has been consistent resistance at that 261.30 level. 1, 2, and all these wicks right here kept hitting it. We do see a morning star pattern here, which is a very bullish pattern. So that's something to be mindful of, that I'm paying attention to. RSI, though, is also pretty extended. Not extended. It's getting up there, I'll say that. It's not fully extended. On the weekly, I'm trying to see if I see anything. Again, like I said previously, 200 EMAs is pretty significant levels to be watching, because as we see here in the weekly in April, which is essentially like when I just talking about the extreme fair that we were in, it literally bounced off of that 200 EMA and it's been going ever since. So if you were paying attention to SMH and keeping in mind of those things, then what was it? The RSI was at 26 at that time. Money flow index was at 40. Definitely oversold at that point. And if you were paying attention and caught that, I mean, from 173 to 247, that's some good money. Can't be mad at that. That's some good money. Let's see what we're seeing on the daily. Daily is more so extended on the RSI. Let me just see what we're seeing on the MACD. MACD is also showing some sellers losing steam here on the monthly channel, on the monthly time frame. Weekly, we do see buyers starting to fill in. The MACD has turned bullish. Daily, we're just in a consolidative phase right now. After gapping up, when was this? May 12th, we gapped up and we've just been consolidating since then. So it's interesting to see what will happen. What's that, 235s? If it gets back to 235, I'll be interested to see what happens after that. But yeah, those are a few of the sectors that I've been paying attention to. And I'm going to share again presentation so we can go into a mindset and takeaways that we can have from here. Let me just take myself off. So last year's surprise rally came from underestimated sectors, actually. Whoops. Let me pull this up again. 1 second. There we go. Um, this year, I mean, it's just June. We just started June. So I don't know if it's really slower per se or if there is a rotation happening, but that's something that we'll have to look out for. Because, like I said, last year we saw tech carried all the way to July and then rotation switched. So it's important, like I said before, it's important to be very much so selective and intentional with all the uncertainty around the market right now. Last year, as we discussed, the hope of cuts lit the market up. As of right now, we're still waiting to hear about if there will be a cut coming in July. Because of the lack of certainty, the market has been very shaky. So it's important that you do play defense while watching the Feds closely to see what decisions they actually make. Last year, trading wasn't a big concern. This year, it's the biggest drag I would say on the growth at this point, and it's one of the main reasons why the market isn't flying like it did in that first half of last year. Last summer, as we saw, consumers did power the market. This summer, they're protecting their capital. That mind shift, that mindset has shifted so drastically. So it's going to be interesting to see what happens in this month and going forward. I'll be watching that quite closely. Um, Keep in mind the next Fed meeting for the decision of the rate cuts will be June 17th to 18th. So that's going to be a quite volatile day, I suppose, like any other day that the Fed speaks. All right. So again, like if you guys like this breakdown, make sure you subscribe, follow, share with somebody who's interested in learning about investing and how to do research. That's what I'm here for. So till next time, have a great week and look out for any other short videos that I may post. I'll share my socials and description for when those are released.